go over how insane credit spread returns can actually be. So I already prepped this chart. This is the S&P 500 on the daily, the most stable stock, not very volatile, things like that. Super reliable, super dependable, and you probably should not get crushed trading this stock. That's the whole point. This is a very safe stock to use credit spreads with. So I already prepped the chart like crazy. All the support levels that we have that this stock obviously can bounce off of to stay away from our level. So just looking over here, we have this support level, this support zone. We have this support zone right here with multiple touches. I circled every single touch just so you can naturally see exactly what I'm talking about. Another level down here, very clear low, super clear low. And I got these levels back here that date all the way, circled them just to make it easy. So currently the price is $693.18. Okay, so I decided we're obviously going to set our strike prices for our credit spread beneath all of these levels. So it's currently at $693.15. I set it down here at the red level at 645. So our first leg is going to be at 645. For us to lose, buy needs to drop almost 7%. That is obviously a huge loss and a huge trend in a single month. I'm going to choose a month option just so it's even more passive income, so it's easy to see that you don't have to look at your screen all day. You can just sell this kind of credit spread on SPY and make some very great returns. So with a 7% drop, you can still make some very great money. So let's go into the brokerage and see exactly what this looks like building the spread and how much money you're actually going to make. Okay, so here's a fresh slate. So obviously our first leg was the 645. So we're going to sell the 645 put. So we're going to find it, which is right here, 645 sell put, and then you have to buy a put underneath it to protect that sell put level. Because right now this is just a cash secured put. So obviously, as you can see, I can scroll over. You need $65,000 just to do this. Obviously, we're not doing that strategy. So you buy a put beneath it. We're going to do a 5 strike price spread. So our actual collateral will be $500. So we're going to buy the 640 put. Now, as you can see, we have created a put credit spread. So seeing this, we can see our max profit will be $34 and our max loss is $466. So we're putting up $500 as collateral and we're receiving $34. So obviously we can only lose $466, which doesn't seem incredibly flashy, but when you actually look at it in a calculator, I mean, it's pretty crazy. So if you take 34 divided by 500, which is your collateral, you have almost a 7% return on investment, and this is a month out strike price. So as you can see, we have a ton of support levels to go break beneath. We have very great conviction. SPY is uptrending right now. Tons of support levels beneath it. And the stock has to drop almost 7%. And we're actually getting 7% in a month. And all SPY has to do is not close below 645 within a month. That is basically a credit spread and super great strategy to use on these big, huge indexes. You can net huge returns. Obviously, if you want to be more aggressive, you'll get paid even more. If you want to be less aggressive, even more safe, you'll get paid less. You can probably get paid 4 to 5% on your return, but you'll get even a way lower strike price. So it's up to you and how aggressive you like to be in the market. But I feel like this is a very conservative strategy. When you're using this exact strategy, follow for more daily education on selling options.